All right, everyone, welcome. So we're going to jump in here to Chapter 1, Part 1 of the Warrior Pro class and the day trading course, the small cap day trading course. So in this chapter, I'm going to introduce you in a little more detail to my trading strategy. And you already know a fair amount about it, perhaps just through watching me trade live in the chat room, but also from the starter class. So before we do that, let's talk a little bit about the current Warrior Pro curriculum. Curriculum is subject to change a little bit. As I go through this class, there may be some things that I decide, maybe I want to switch these chapters around or adjust it a little bit. But as it sits right now, this is the curriculum. We've expanded this out to 20 chapters as of right now. And this is a comprehensive course that is designed to teach you all of the ins and outs of my strategy, plus teach you some of the more complex topics of level 2 and dark pools of liquidity, adding liquidity, removing liquidity, different routing types, different hotkey types, offsets. And then certainly we'll talk a little bit about taxes. We'll talk about creating a trading plan, putting together some good rules for trading momentum without getting too carried away. Buying high, selling higher, of course, is risky, as today is definitely a good example of that. But when it works well. So this is where I'm sitting on the day right now. $448,000 in the green in this account, plus another $27,000 over here. That is almost $480,000 on the day, $476,000. And believe it or not, I'm a little bummed because I was up about 525, maybe 530, and I gave back 50,000 off the top. Well, I flew a little too close to the sun, and that happens with trading. Certainly, it's always it's important to know when to walk away. And you usually don't know when to walk away, because I literally could have stopped trading today when I was up 15,000, 25,000. I could have stopped when I was up 100,000. When do you stop? I usually stop once I start giving back profit. And when I start giving back profit, I'll say, okay, if I'm up anything less than X amount, I'm done for the day. And so then at that point, if that happens, I'm done. Or if I can take a couple trades and start to kind of rebuild my cushion off of that sort of max number, that number where I walk away, then maybe I'll be able to rally back up and recover the losses. And if the market continues to be hot, that's fine. But we'll get into that in more detail in position management, trader psychology, building discipline, and recovering from losses. So as we go through the chapter specifically on gap and go, momentum trading, reversal trading, short selling, and high-speed breakout trading, I'm going to show you lots of live trading archives, and you guys are going to want to continue to access those live trading archives, which actually upload into a separate section. So we have the classes here, and then there's a separate, it's almost like its own course of my live trading archives. And that's a place where you can go in and you can see my latest live trading archives of, what, trades from today are going to get uploaded. Trades, when you're watching this a year from now or whatever it is, those trades will probably also get uploaded. So you get to kind of keep watching those. I encourage you as you go through this class, certainly to take lots and lots of notes, notepad, pen, whatever, pencil. And I encourage you to watch those live archives, because those are kind of like, they're the closest way of really kind of like watching directly over my shoulder as I'm taking those trades and understanding, okay, that's what he's seeing. That's why he got in there. That's why he got out there. All right, so let's go ahead and jump in. A couple of housekeeping items. As always, please, I hope you guys have watched every chapter of the starter. The Warrior Starter course is a prerequisite to the pro. I know that some of you are going to say, listen, Ross, I've been trading for 5 years. I don't need to take your starter course. I'm just going to jump into the good stuff. Well, and that's fine. And I understand that on the one hand, just adjusting the mic here. However, what I would also say is that the starter breaks down for you some of sort of the foundational views that I have on the market and that are dictating my strategy and the way I trade it. So I do encourage you to go through that chapter. In that chapter, we talk about what quantifies a stock to be strong. We do the breakdown initially of technical analysis with chart patterns, candlestick patterns, daily charts. We talk about gaps. We talk about windows. We get into the basics of level 2, the basics of walking through a platform and how to start taking your first trades. So if right now any of those things sound a little foreign, it might be a good idea to go back and check the starter class. But for everyone else, we'll go ahead and continue on here. And if you ever need to pause this class in our learning management software, which is abbreviated to the LMS, you can pause it, come back, and watch it later. I try to keep the classes usually not more than an hour for each individual class, so you can digest them fairly easily. And sometimes a chapter is going to be split into 5 or 10 parts, each less than an hour, but sometimes we'll have a few classes that go longer. Step 2, I do encourage you to log into the chat room as often as possible so you can watch me trading and watch the other students in the chat room trading. It's helpful to see how other traders are approaching the market. You learn from experience. You learn by surrounding yourself with people that are all trying to do the same thing as you. Definitely begin using a trading simulator, and don't trade with real money, but trade in a simulator as soon as you feel comfortable. Even if that means just kind of, taking a few trades here and there and just sort of breaking the ice a little bit, it's fine. Break the ice a little bit, give it a try and see, see how it feels. That's the purpose of a simulator. Again, I'll emphasize this and say it a million times. Don't trade with real money until you've completed the pre-trading checklist at the end of the Warrior Pro class. And don't try to blindly follow me. You may see me making money, and I hope you see me making money. And there may be times where you think, I'm just going to follow Ross. Well, the problem is, you don't necessarily understand if you're at the beginning of the class, you don't necessarily understand the strategy at all. So you may hear me getting in, but you may not understand my exit strategy, how I'm going to unwind a trade, where I'm going to start selling. And presumably, if you're just blindly following, you're going to be a step behind me. I want to teach you to be side by side with me, seeing the same thing as me. So if we're watching a stock and I'm saying, hey, I like this over 75, there we go, there's 75. I'm already in. Now you say, oh, he bought, I'm going to buy now at 76. You missed the trade. You missed the entry. So I want you to be so dialed in on the chart patterns and perhaps on the level 2 as well, that maybe you take the same trade as me because it's the very obvious setup, but not just because you're blindly following me. I will say both through the starter and the pro classes, students who skip classes, students who don't follow the rules of the strategy, students who trade the wrong type of stocks or who trade with real money before they're ready are students that are more likely to fail. So don't be like that. Prove you can be profitable before trading with real money. I sound like a broken record, but it's better to say it too much than for someone to say, I didn't know and I lost. So this is sort of the process of becoming a day trader. Step 1, learn the terminology and the core concepts. You can learn some of that just through, reading a book on day trading. You can learn some of that through watching, a couple videos here and there. But you'll learn a lot more through the ins and outs of the Warrior Starter and the Warrior Pro course. And you're going through that now. Step 2 is learning a trading strategy. Strategy development is what the pro class is all about. Step 3 is learning the advanced concepts and how to use the best tools. We'll be covering that as well. Step 4, writing and documenting your trading plan, how you are going to attack the market every single day. We're called day trade warriors because you have to be a little crazy to try to battle this market. And it is a battle. Every single day is a battle. And some days you win and some days you lose. And coming to the table every single day, ready to trade, ready to follow your plan is key to success long term. Review your simulated trading metrics. And we talked about this at the end of the starter class, so I won't harp on that. And then begin trading with real money only once you've proven you can be profitable in a simulator. So what you're going to learn today is the overview of my momentum day trading strategy. I'm a momentum trader. And we're going to talk about the importance of float. And I'm going to talk about why I don't trade penny stocks, even though they can make big percentage moves. And you might think that, Ross, those would be the most obvious ones to trade. I'm going to explain why I don't trade them. And then we're going to talk a little bit about finding your place in the market. So I'd like to introduce you to my friend, Momentum. We've been friends for a long time, great guy, and I trade momentum every day. So the strategies that I trade are primarily momentum strategies. Now I will say that one of my trades that I took today on GME was actually a reversal strategy. So after this big sell-off, I bought the dip at $125 a share, or whatever that was, and we got a really nice bounce. So we'll talk about the reversal strategy. I believe that's chapter 9. But generally, with the exception of trading these types of reversals, I trade momentum, which is trading stocks in the direction they're going. But when a stock is really stretched out at extremes, sometimes it makes sense to short the top or buy the dip or buy the low, which was the case in this example. So generally, regardless of whether I'm trading reversals or momentum, I'm looking for stocks that are moving quickly. I look to jump on that trend, that momentum, typically. And I will teach you guys several subsets of this strategy, including the gap and go strategy, which is a subset for specifically trading the open. I'll talk about the ABCD pattern, the red to green move, the break of VWAP, the fade off VWAP, the bounce off VWAP. There's a number of different strategies that we're going to cover. And then we'll also talk about the reversal trades for catching opportunities like this. And we'll talk about some short selling strategies for trading the backside of momentum, so as it starts to fade back down. So this is kind of the high level of my momentum strategy. It's valid on all price ranges ultimately, as long as the stock is moving at least 5 to 10%. However, in order to maximize growth on a smaller account, I'll typically focus on stocks under $20 and with floats under 20 million shares. Now, in fact, GameStop met neither of those criteria, being a $200 stock and with a 50 million share float. But as you can see, it had enough of the other characteristics of the right type of stock to trade. The move was phenomenal, a huge move with quick moves, extremely high relative volume, a clear catalyst in this case, which was a short squeeze. And this was the right stock to trade. Despite the fact that the price and float were a little higher, the opportunity was definitely still here. So my general approach is buy high, sell higher. And that is definitely in contrast to the old saying of buy low, sell high. But you can't really buy low, sell high as a day trader unless you're always trading reversals. But that's not the most profitable strategy for me. Trading with the trend and jumping in things that are already moving is a much better intraday strategy. However, because I'm buying high and selling higher, I do need to use tight stops. Usually a max loss of 20 to 30 cents in about 99% of my trades. So tight stops. Again, the exact stop, we'll get into the details of that when we get into strategy, but usually trying to keep tight stops. And then adopting a breakout strategy for me has been really profitable, where I get in and I take profit quickly into the first breakout. So I sell half once I'm up 10, 20 cents, typically. And then I adjust my mental stop to break even. Again, not a live stop. We talked about this during the Warrior Starter course. And then I'll add back on the next move up. And so if you look at my orders, they're often buy, buy, sell, sell. Buy, 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 sell, sell. Buy, 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 sell, sell. So my positions are going up and down, almost in tandem with the chart, going up and then pulling back, and then going up and then pulling back. And if I do it well, then my change in P&L will actually be just before the chart goes up, right? Or my change in position size. So I have full position before the breakout, and then I unwind my position to small size before the pullback. And then I size back up before the next move up and size back down before the next pullback. That's the idea. And that's not just a momentum strategy, but also a breakout strategy to take those profits fairly quickly. And that's what's allowed my accuracy to be as high as it is, although it does come at a cost, which we talked about in the starter class, which is that as a result of having a high level of accuracy here, my average winners are not as big as I wish they were. My average winners have gotten small because I take profit off the table quickly. And that can hurt me in the odd chance, the off chance that I get caught with a big loss. My current biggest loss ever is $58,000. And while that's smaller than the biggest winner I've ever had, which is good that those are, opposing in size, it's still certainly far in excess of my average losing trade. But of course, the winner's far in excess as well. So again, but keeping losses tight is going to be important. Otherwise, you're going to have a negative profit loss ratio. And if you can't maintain at least 60, 70% accuracy, you're going to lose money. And then back here, increasing size once I have a profit cushion on the day. So we'll talk about this a little bit more when we get into sort of how trade management, but just in summary, I have two sort of different approaches. One approach that I've taken over the years has been, excuse me one second. One approach I've taken over the years has been on my first couple trades to swing big, to try to get a cushion. Because I want to get a cushion right away. As soon as I have a cushion on the day, I feel like, okay, I'm in the driver's seat. I feel confident. This is what I wanted. Unfortunately, if I do that and I miss on the first trade or the second trade, then I'm starting the day deep in the red. I'm right away up against the ropes. If that happens at the very beginning of the week or the very beginning of the month, I can start to feel that emotional impulse to try to recover quickly because of the implication that now my month is ruined and it's the first day of the month, or now my whole week is ruined and I'm going to spend the rest of the week digging myself out of the hole. So the alternative way that I will trade and I'll do this more early in the month and early in the week when I'm a little more conservative, is I start with a couple of smaller size positions where I jump in and I take quick profit. Green, great. Then I jump in, take a quick profit. And then once I've got a little bit of a cushion, then on the next trades, I'll start getting in and adding to size up for a bigger winner, knowing that I already have a cushion on the day. Now, if we actually look at my P&L based on the day of the week, you'll notice this interesting pattern where it's the lowest on Mondays, increasing all the way through the rest of the week. And today's a Thursday, and I'm up 400,000, 500, almost 500,000. So why do I have that pattern? This tells a story of my sort of trader mindset, which is at the beginning of each week, it's a fresh week. I'm starting at 0 on the week. And so I take it a little bit easier on Monday. Not to say that I won't be aggressive if we have great opportunities, but my first goal, first and foremost, is to try to build that cushion. So I start a little more conservatively on the first trades, take a trade, make some money, take a trade, make some money, and be grateful for getting that 10 cents a share. I know on days like today, I probably got, I don't know how much per share I got, dollars per share out of the market today. No question about it. But 10 cents a day. Can I get that 10 cents? 3,000 shares in and out, that's $300, 10 cents. Do it twice, that's now 600. Do it a third time, now I'm up 900, 1,500 on the day. Now I've got a little bit of a cushion. So on the next trade, maybe I take 3,000, double to 6,000, or triple to 9,000 shares, stop goes to break even once I'm adding as it goes higher. And then if that trade works and it goes into a 30-cent winner, I've got $3,600, and just like that, I've gone from 1,200 on the day, let's say, up to 4,500 or 5,000. And if it doesn't work, I stop out break even on that trade, but I still have my cushion from the first 3 trades where I was more conservative. Now, if Monday goes well, on Tuesday, I step up to the plate a little bit more, using Monday essentially kind of as the same cushion that I used the first 3 trades on Monday morning as. So now Monday as a day is a cushion on the week. Hey, I'm already up $5,000 thanks to Monday. So going into Tuesday, I feel like I can work a little bit. I'm not up against the ropes. I get aggressive, it pays off. Then going into Wednesday, even more so. Going into Thursday, even more so. So what's different about Friday? Well, it's Friday. The weekend's almost here. I don't want to screw up on Friday and ruin my whole weekend. You don't want to spend the weekend with me if I lose a ton of money on Friday, because I dwell on it the whole weekend. So I'm thinking about Saturday. I'm thinking about Sunday. People say, Ross, what's the matter? You're just staring off into space, just staring at that rock over there. Yeah, well, I lost money on Friday. So because of that, I really try to adopt this practice of aggressive midweek and then ease off on Friday. So again, that's telling a little bit of a story of my trader mindset. Okay, so increase size once I have a profit cushion, that was number 5, and then sizing down as the day goes on. All right, so here's a great example of momentum. This is a stock that I certainly traded and would be excited to trade anytime I see a setup like this. Stock goes from about $2 a share up to $6, 300% in one day, right? We'll take that. We'll take that any day of the week. Now, inevitably, some of these types of moves are going to be very clean. Sometimes we'll see stocks that go, straight up. I mean, we've seen close to straight up moves in GME on the 1-minute chart, but other times we'll have periods where, a stock is kind of choppy and it's not easy to trade. So we trade what the market's willing to give us, whether it's, really awesome price action or it's a little choppy. And in this case, on a 1-minute chart, it looks like we would have gotten a nice 5-minute bull flag right here. And then we got a nice one right here and a little false breakout here right at the open, very common. It goes red and then it curls up and makes, kind of this bigger move. So that was a nice setup. And again, that's not to talk about setups as much, just to kind of give you a taste of what we're looking at. So one of the big things that I'm going to harp on during this class is that you have to be aggressive if you're going to try to day trade my strategy. I am extremely aggressive. I try to anticipate breakouts, take quick profit through the breakout, and then add back for the next leg up. So as an example, if I'm anticipating the break through a $0.50, my entry might be at 345, a double at 348. So as I'm seeing volume coming up, which of course we know we can recognize by reading the tape and the level 2. So if we're seeing volume coming up as the stock is squeezing up to the nearest $0.50 or whole dollar, and typically this would be more on a stock like of this price range, so like $9, let's say. So as it approaches 9 or it approaches 750 or 950 or whatever, or 850 or whatever it is, I would typically look for an entry at 345, 348 to anticipate the break through the $0.50. I sell half on that surge through the $0.50 as short sellers are covering positions as it breaks through a psychological resistance, therefore showing strength. I then maybe sell a little more at 62. I expect that it might pull back down to the $0.50. Often as we break through these levels and then pull back down to them, we can see a little bit of a struggle. So I let it break, let it pull back down to that level, and then maybe I'm adding back at 390, doubling at 398 for the next whole dollar break, selling at 408. And each time I take profit off the table, I usually adjust my mental stop to approximately break even, not to break even on my P&L. So I would close the day zero on the trade, but break even versus my cost basis. So ZVZZT, for instance, NASDAQ test stock, I'll just do it on this one. So I'm in there 100 shares. So my average price is 10.02. So if this keeps going higher and I sell half at 10.08, then I'll say, okay, stop is break even at 10.02. And I can put a live stop order out at break even if I want to, but usually I just use it as a mental stop. So trading in this way, you have to be very fast. You have to read the tape. Now, it's not to say that that's the only way to trade, because you can certainly trade in a little bit of a slower way where you're focusing on 5-minute time frames and buying the first candle to make a new high and not staring and focusing as much on the level 2. Perhaps out of curiosity, so at the end of the Warrior Starter class, we did your new trader assessment. And one of the goals of that was to help guide you in the direction of where we think you'll thrive in the starter or in the Warrior Pro classes. And kind of just to articulate a little bit about that assessment, I'm asking myself, do you have what it takes to trade at the high speed level that I trade? Or do you need to focus on a modified version of momentum that slows it down? So if you have good computer aptitude, if you have good reflexes, if you are willing to take risk and willing to make quick decisions, then I would be more apt to say, okay, you sound like someone that might be able to do really well trading on 1-minute time frames, buying micro pullbacks, taking quick profit, and capitalizing on the market in a very similar way as me. If you're someone who doesn't have the computer aptitude, who doesn't like making quick decisions, who would really prefer to take a trade and hold it and think about it for a little bit, I'm going to encourage you to move away from the 1 minute and look more at the 5-minute chart for finding your entries. And in that case, using the level 2 a little bit less. It doesn't mean you might not still anticipate your entries at $0.50 or whole dollars or at the apex point, but it just means that you would probably not be trading the breakouts as quickly of jumping in, getting out, getting in, getting out. And that's fine. I mean, there are traders, the first 5-minute candle to make a new high on a reversal right here, in fact, went from $132 all the way up to $250. And then this 5-minute bull flag here went from $240 up to $300. So in this case, you actually, even with smaller share size, might have made more on the 5-minute charts than I made trying to aggressively trade the 1-minute chart and then get stopped out repeatedly. So so I encourage you, as you're going through this class, to be mindful about sort of which approach you're going to take to trading the strategy. But in any case, if you're trading momentum stocks, there has to be a willingness to be fairly aggressive. If you want to just buy and hold Tesla or Facebook or Apple or something like that, by all means, it's your money and you can do as you'd like. But when we're trading a stock like GameStop, and today at one point it was up almost 100% versus yesterday, and then it was down almost 70% off the highs. That's crazy. So you do not want to get in a situation where you're buying one of these and then you just freeze. So you have to remember to cut your losses. You have to be aggressive. You have to get in, take your profit, and get out. Get that 10 cents a day. That kind of sniper approach of just, being calm, cool, collected, waiting for that one opportunity to grab your 10 cents, get it, and then get the heck out of there. And then when you get good at that, you'll be able to do that multiple times through the day, and maybe you make more than 10 cents per share per day. But the willingness to be aggressive, it's important for any type of momentum trader. And that means aggressively protecting your profit by taking it off the table, aggressively protecting your account by respecting max losses, and aggressively getting in and out of trades that show potential and are clearly moving. It means, as much as you can, capitalizing on volatility in the market and capitalizing on the heightened emotions that will exist in the market from time to time, while not falling victim to them yourself. And that is a very fine line that almost any day, certainly like today, I'm on both sides of. And at moments I'm like, I'm emotionally trading right now. I'm getting too aggressive. I know I should stop and I don't want to. Why is that? I'm frustrated. So it'll happen even to me. And that's a challenge with being very competitive and aggressive, with the market and with yourself, that you'll sometimes find yourself on the wrong side of that line. Through the trader psychology classes in the starter with Ted and Diane, and through how we expand on that in the Warrior Pro classes, I think that you will get a pretty good set of tools and sort of coping mechanisms to help you handle those emotional triggers and to help you get recentered when you do find yourself going off the rails. But to be a momentum trader and to trade this market in this technical way that we trade it, where stocks are just crazy, and sometimes they can be just crazy, you have to be aggressive, and you can't let yourself get in a situation of holding and hoping. So let's check out this quick video here. Let's see, where's my notes? So this is just kind of a cool example of I think this was a 5-minute setup. And just to show you kind of an example of me stepping up to the plate a little bit. Okay, so I'm gonna press play here. And on this stock, I'm actually gonna try to anticipate the first 5-minute candle to make a new high. So let's just pause this for a second right here and look at the chart. So right now, we've got a green candle and then a red candle. The green candle was on higher volume, which is good. The red candle was lighter volume. We have a pretty bullish 5-minute pattern. We've pulled back, and now what I'm looking for is for this green candle to break over the high of the red candle. But it's also, the high of the red candle is just over the $0.50. So what I'm really looking for here is a break through the $0.50. All right, so I'm gonna anticipate the break through the $0.50 with an early entry. Watch it here. Order, hands on the buy button right there, and now I'm in at 47. So we can see a 40,000 share seller on the ask on the level 2. A risk of, well, anytime I take a pattern like this, there is a risk of a double top. But at 9:40 in the morning, when we have such high levels of momentum, that's usually the best time to see a nice breakout. So I don't think I'm too worried about that right now. But we do have a big seller there at 50. And now it's dipping down. And so when it pulls back off that level, we look for that to kind of reload, gain strength, and then give it a second try on the breakthrough, the attempt to break through. So I put my order at 51, which creates a 1 cent offset, as you know. And now there's 47, 48, 49. Here we go, 50. There we go. So I added right there. This order didn't fill. So several of my orders did fill down here, but one of them did not. Now it's better that it doesn't fill than I get a bad entry. Now in this case, I was clicking the buy button to send my order. I could have just as easily pressed Shift 1 with a hotkey. However, something we'll talk about as we get further into the classes on and really get into trade execution is that when you press that hotkey, you're buying it basically current market price plus 5 or 10 cents what your offset is. And so the challenge with that is if the market moves really quickly, the moment I press Shift 1, it's possible that by the time my order was received, that it was already at 255, and then I'm paying a higher price. So to really control for sure how much I'm willing to pay, using the order entry window here is the best way. And so I will use that a lot of times on entering trades. Okay, so and now at this point, it would be quicker for me to press Shift 1 to add than to go in with my mouse and then click to increase my share size. So oftentimes my first entry is with the order entry, and then once I'm already in, then at that point, I'll add with the hotkey of Shift 1. Okay, so now we're looking for the break through this level. There's 65. So right now, what have I gotten? 10 cents. I got my 10 cents a day. So I could happily sell this right here for $1,400 of profit. Now, in this case, it's almost 20 cents on the ask at 68. I could sell it for 20 cents. Now, if you have 10 shares, you're going to feel like it's $2. It's not worth it. You have 100 shares, you've got 20 bucks. You've got 1,000 shares, you've got 200. You've got 10,000 shares like I do, in this case, and I've got $2,000. Now, this is going to be one of those times where I kind of will use my discretion and say, I'm going to hold this for a little bit of a bigger move. So it does come back down a little bit, kind of retests approximately the $0.50, and then we look for it to continue back up through the high. So we get that first pullback, and then we're looking for the move higher. I got my girl here. Hi, girl. We're watching a live trading video, girl. Where you been all day? 68, 70. Okay, so 20 cents again on the ask at 68. It's kind of struggling here. You can see on the 1 minute, we do have a little bit of a double top, but now there's 70, 72, 73. So this is continuing to go higher. Now in this case, look, I'm going to increase my max share size to allow myself to trade it a little bit more aggressively. I have a cushion, and so I'm thinking, you know what? I've got a cushion. Let's set my stop at about break even, and let's see if I get the move on this up towards $3. Let's ride that momentum. So, you know, again, this is just an example of that entry to anticipate the breakout, the willingness to be aggressive, and I think this goes up to like 75 or 85, and then I take the profit off the table. But more than anything, I just wanted to kind of show you, so I'm actually adding there for the move higher, and I think the target was around 75 or 85. So, you know, this ends up being a nice 20 cent, 25, 30 cent winner on 11,000 shares. Adding as it's going higher is something I'm okay with, because see, in that case, even though my average cost did increase, it only went from 47 to 50. That's not that bad. And now I can potentially make a little bit more with slightly bigger share size. Okay, so back here, and let's go to present. Okay. So I just wanted you to see that again as kind of that example of trying to anticipate the first candle to make a new high, and of course, an attempt at being fairly aggressive. Now, number two, the importance of float for account growth stocks. If you're trying to grow a small account, which initially many of you may be trying to do, and that's what I was trying to do when I got started. So even though I've grown to a larger account, my strategy is still, I mean, the strategy that I learned and that I've taught myself and that I teach you guys is based on trading a relatively small account. So stocks with floats of under 20 million are typically among the stocks that can make the biggest moves in the market, 20 to 30%, but even all the way up to 50, 100, 200, 300, 400, 500%. Now, GME is a little bit of an exception to that, as it's made this just unbelievable move from like $20 up to $500. Today, it hit a high of $513, which is crazy. So this is a little unusual, but the float's about 50 million. It's still pretty low. And some of the people that have been trading this have been saying, oh, you know which one's going to be next? It's going to be Nokia, or it's going to be, I don't know. They've got a couple others that they've been talking about. So the float on Nokia, just for your reference, is 4.7 billion shares with a B. The float on BlackBerry is 500 million. So the type of move that might be reasonable to expect of a 50 to 100 million share float stock that's, you know, got a lot of attention, a lot of people watching it, is definitely different than the expectations of something like Nokia that has a 4 or 5 billion share float. It just, it's common sense once you know and understand how much float impacts price action. So the lower the float, the greater the imbalance between supply and demand. And essentially it means with a lower float, it requires less demand for that imbalance to occur. And so in the case of GME, that level of demand on Nokia, a stock with 100 times the float, that same level of demand would not have been enough to generate that same move in stock price. It's an imbalance in supply and demand that creates the move in stock price, right? More people buying than selling. So you have supply and you have demand. So the same exact level of demand will affect different stocks differently. Stocks that have huge levels of supply, that demand's not even going to move the needle. And then stocks that have very small levels of supply, that same level of demand not only could move the needle, all of a sudden you could see a huge surge. So it's always important to remember that we're trading in a closed market. We're buying shares from someone who's selling. We're selling shares to someone who's buying. And when stocks have smaller floats and fewer shares available to trade, that's when we usually start to see the extreme moves. So as you know, during the initial public offering, that's when they sell the shares onto the market, and that number, the number of shares sold onto the market, becomes the float. We will talk about reverse splits. We will talk about buybacks and secondary offerings during this class, but not chapter 1, but actually in chapter 3. But just so you know, float is that fixed number. So we're all trading out of the same pool of shares. And if a company has 70% institutional ownership, the amount of float that's actually available to trade on a daily basis could be as low as 30% of the total float. But of course, that depends on what the institutions are doing with the shares that they own. If they're using high-frequency trading algorithms on that stock, or they're lending those shares out to someone else, we don't always know. But a stock that has a float of 10 million shares may actually only have 2 or 3 million shares, just thinking out loud, that are actually sort of freely available and trading hands. And of course, market makers would hold positions as part of their duty to provide the market and liquidity for a stock, and they get compensated for that by creating the spread. So again, the reason why float is important, of course, is because it represents the supply side. Very limited levels of supply, usually less than 50 million shares. The stock can move very quickly if there's high demand due to breaking news, typically, or some type of catalyst. A company like Bank of America that has a float of 10 billion shares, in a practical sense, it means a stock like Bank of America will move very slowly. Even great news is unlikely to result in a massive move in the stock. So as day traders, we're going to be looking for those 3-4 stocks each day that are making the biggest moves in the entire market. And you will find that among the things they have in common, one of them is almost always that those leading momentum stocks have lower floats. So just as an example today, these are the top 3 leading gappers in the entire US market today: JAN, ACY, MNPR, and NAKD. The floats: 1.14, 1.2, 2.94, and 436,000 shares. These are low float stocks gapping up between 60 and 133%. This is very common. And these have, well, this has an unthinkable amount of volume, almost 1 billion shares traded, 1.6 million shares traded on this one, 2.7 on this one, and about 6.9 on that one. So they all, except for MNPR, have a decent amount of volume today. So these are the types of trades or types of stocks that we want to focus on. And we can tell by really just pulling up the level 2 whether or not a stock looks to be more thinly traded and therefore has the potential to make rapid moves, or if it appears to be more thickly traded. This is a low float level 2, and this is a higher float level 2. It's, we can look at a million stocks like this and see this pattern. Here's Bank of America today. Here's GBR. Here's Sirius Satellite Radio. Here's GME, GameStop. Here's Ford Motor Company. Here's JAN. See how different the level 2 looks when you look at those different stocks. It's completely different. And so that communicates to us the reason there's so many more buy and sell orders is simply because those stocks have much higher levels of supply with larger floats. And naturally, there's more algorithmic trading happening on them, more high-frequency trading algorithms, more hedge funds and institutional traders holding positions to try to profit from the spread, which is certainly going to be less risky for them than trying to do the same thing on a stock like GBR, which is up 129% today. So GBR here, 215%. GE is down 1%. And so if a market maker or a financial institution is holding GE and they're on both the bid and the ask, and every time they sell shares to the bid, they make $100, and then they sell it back here, buy it back here, they make $100, 10,000 shares every time it goes. So every time those orders are crossing through, they're making $100 on the spread. And they can pretty much rest assured that the millions of dollars of capital that they have tied into GE that allows them to do those types of trades all day long, it's not really at that much risk because the stock it never really goes up or down all that much. It's down 1% today. They're not going to be interested in doing that type of thing on stocks like GBR. And that combination of lower float and lower levels of institutional interest is an important combination because it's the institutional interest that creates the high-frequency trading algorithms that on some stocks are the majority of the volume. And the computer programs, as they are right now, they're not trading the stock to create a bull flag or an ABCD pattern or a flat top breakout. They're just getting in and they're getting out, they're getting in, they're getting out. And so the charts look really weird. So let's look at the chart of Sirius Satellite Radio. So chart's loading kind of slowly, but Sirius Satellite Radio, this chart, yes, it's drifting lower, but it's not an obvious chart. You look at the chart for Ford and the overall mark, usually these stocks will trend with the S&P 500. And so I can check to see what the S&P 500 is at. But these are not patterns that you're going to feel comfortable trading 99% of the time. So we try to avoid the pockets of the market that have very high levels of institutional ownership, high levels of high-frequency trading algorithms, and focus on the 1 or 2 stocks each day that actually have a reason to move and therefore are going to have real people executing orders. And maybe some of those real people do work at hedge funds or at banks, and that's fine, but they're getting in because the stock is doing something special. So the perfect storm for us for a big 20, 30, 40, 50, 100% move is the combination of lower float with a clear catalyst, a great daily chart, and then terrific intraday setups. Now, I love volatility, but I don't love penny stocks. So why not? Well, the problem is, I started, when I first started trading, I was trading penny stocks. And officially, penny stocks are sometimes considered any stock under $3, or sometimes are considered any stock under $5 or any stock under $10. Now, in truth, a stock priced at $3 is not a penny stock based on what you would assume is the literal definition of penny stock. I would consider the literal definition to be, I don't trade penny stocks because I don't trade stocks below $1. Do I sometimes trade $3 and $4 stocks? Yes. Do I consider them penny stocks? No. I personally don't, because they're not a penny stock. They're at $4. But again, there's different, people use different kind of cutoffs. So I think the SEC considers stocks under $3 to be penny stocks. So by that definition, I trade penny stocks. But I focus usually on between $1.50 and $3, maybe up to 10 or higher, or 20 or higher, depending on the setup. So these stocks meet the listing requirements to be on the New York Stock Exchange or the NASDAQ or Amex. And with strong headlines, good financials, good earnings, these are companies that could work their way up into the teens to 20s and higher. So, up from 10 to 15 to 20 to 25 to 30. And we can look at a number of charts of companies that have had really impressive moves over the years on the daily chart. Perhaps this isn't the best one, but let's look at Plug Power, for instance. This was a small cap stock for a very long time, low priced, and $2, $1, and it just kind of started creeping up, and some good news started coming out, and next thing you know, it's at 10, 14. It's up at $70 a share now. So this is one that has gained some real popularity, and we will see that happen from time to time. So anyways, I focus on NYSE and NASDAQ listed stocks. Now, with NYSE and NASDAQ, they both require companies to maintain a minimum stock price of $1 a share. Okay, $1 a share is the minimum. Now, you will see NASDAQ and NYSE listed stocks trading below $1, but anytime they're below $1, technically they're not in compliance. So they can get a delisting notice from the exchange, which is when the exchange says, hey, we're going to kick you off the exchange unless you get your stock back above $1. And if they get kicked off, they get knocked down to the OTC market, right? So we don't trade OTC stocks, and we'll talk about that for a second. Now, one of the differences between stocks above $1 and below $1 is that as a result of decimalization, prior to decimalization, stocks in the U.S. market traded by the fraction. So a half, a quarter, an eighth, a 16th. So they trade in fractions, which is silly. So I can't remember what year it was, but we converted the market to, it was called the decimalization of the market, to trading in decimal points. So now stocks would trade to the actual penny. And this was a concern because previously, and let me just do the math here. Previously, the tightest spread, was 6.25 cents. So when a stock traded down to 1/16th, the tightest spread was 6.25 cents. And you know who loved that? Market makers loved that. Market makers loved trading stocks that were trading at 1/16th because they got those spreads. So whether it was a 16th or it was a quarter or whatever it was, that meant a bigger spread. They profit from the spread. So when decimalization occurred, a lot of market makers and financial institutions were scared that that was going to kill their profit, because remember that market makers profit from the spread. They own stock both long and short, or on both sides of, they're both buyers and sellers, and then they profit from the spread. So above $1, anything above $1, a stock trades down to 1 penny, which means instead of 16 intervals between each dollar, which was the case with fractional trading, there's 100 intervals, right? There's 100 pennies in a dollar. Now, I know sometimes people get confused because there's only 60 minutes in an hour, but in fact, there's 100 pennies in a dollar. So please, let's try to keep it together, folks. By the way, it's only 1:15. I hope no one's been drinking. Okay, so there's 100 pennies in a dollar, all right? So as a stock goes up from $1 to $1.02, $1.02 to $1.03, $1.03 to $1.04, etc., the minimum spread can be as little as 1 penny. Now, with the minimum spread as little as 1 penny, obviously the market makers don't love that, but that's the way it is with decimalization. Now, stocks below $1 trade down to the 1/100th of a penny. 1/100th. And so look at the level 2 here. The level 2 on this stock shows you 26 cents, but it shows an additional 2 zeros. So it's 26 cents by 26.27. And if it goes up and breaks 26.27, it goes to 26.29. And if it goes 26.29, then it goes to 26.39, then 26.4, 26.5. All of these orders right here are still at 26 cents. They're still roughly at 26 cents a share. Okay? So effectively, in order for a stock to move up 1 penny, for each penny it can move up, it has so many more intervals. So stocks above $1 move much faster up than stocks below $1, and that's because of stocks below $1 trading down to the 1/100th of a penny. All right. So an 80-cent stock would potentially trade at 0.8198 by 0.8199. So do you think you're going to make a lot of money buying and selling for 1/100th of a penny? Not unless you're trading with 1 million shares. And if you trade with 1 million shares at some brokers, you're going to get a pretty big commission. So NYSE requires all companies to keep their stock price above $1 a share. If it drops below $1, the company will have to have a certain amount of time before they can get their stock back above $1, or they get delisted. And the exchanges, they're reasonable. They give them 6 months or whatever it is. So as we mentioned before, and as I'll just highlight briefly here, we have this mechanism called a reverse split. So if a stock is at 10 cents and the company gets a letter that, hey, you're not in compliance with the rule to keep your stock above $1, they'll say, okay, well, what can we do? And the exchange is like, well, why don't you first just try to be a better company? You guys are a joke. And they're like, all right, well, thanks for the cheap shot, but really, what are we going to do? We're doing the best we can. And they're like, okay, well, fine. You can do a reverse split. So when you do a reverse split, let's say the stock is trading at 10 cents. A traditional split, like with Apple was trading at 700. They did a 7-to-1 reverse split. And the next day, when you open your account, oh my gosh, Apple's at $100. Did it drop? Well, not exactly. If you were holding 1,000 shares at 700, the next day when you logged in and saw it was trading at 100, you probably would have panicked and thought you were down like 90% on the trade or whatever that amount is. But then you would have looked and realized, wait, it doesn't show that I'm holding 1,000 shares at 700 anymore. In fact, it shows that I'm holding 7,000 shares at 100. So I still have $700,000 in stock. Huh, okay. Well, that was weird. So that's a traditional stock split. So stock splits are common, and when companies get expensive like Apple and Tesla and others, the company will do a traditional stock split in order to make buying the stock more accessible to retail traders. So that's fine, but it has an impact on the float. So remember how you had 1,000 shares at 700 and now you have 7,000 shares at 100? The float has multiplied by the amount of the split. So the float has gone up times 7 on a traditional split, or whatever the amount of the split is. If it's a 5-to-1 split, it goes up by 5. In a reverse split, it has the exact opposite effect. A 10-cent stock, they say, okay, we want to get it to $2 a share. Okay, then do a 20-to-1 split. Okay, so if you're holding 20,000 shares at 10 cents, the next day you log in, oh my gosh, the stock's at $2. I should be up, $40,000. And then you realize, wait a second, I'm only holding 1,000 shares. And the price is $2. I still have the same exact amount of money in the trade. And that's because a reverse split increases the price and decreases the shares. Now, decreasing the shares means the float goes down, and that's why this is important. So it's very common that we see this, this pattern of stocks doing reverse splits, and then all of a sudden, the next day after the split, what might have been a 20 million share float, the next day is a 1 million share float, and what was a 10-cent stock is now a $2 stock. Now they put out a couple nice headlines about, this and that. People start jumping on it, and with a 1 million share float, it doesn't take a big imbalance between supply and demand for that to rip up to 250, to 350, to 4, to 5, to 6, to 7. And GBSN is a good example of a stock that, all of a sudden has that big rip, which could also take the form of a short squeeze. So we'll talk about reverse splits a little bit more in Chapter 3, but just so you know, that is a mechanism that companies will use to get their stock back up above $1. At a certain point, if they just are kind of out of luck, they can get delisted and move to the OTC markets. So the OTC markets have different tiers. They've got the OTC best market, the OTC venture market, and then the pink sheet market. So if you've seen the movie Wolf of Wall Street, they were selling pink sheet stocks. Pink sheet stocks don't have the same regulatory requirements as certainly a NYSE or a NASDAQ listed stock, like not even close. And they don't even have the same regulatory requirements as the OTC best market. The OTC best market usually face higher financial standards and must demonstrate compliance on multiple fronts. On the OTC QB market, the venture market, companies must be at least 1 penny a share and cannot be in bankruptcy. They also have requirements for annual reporting and certification. And on the pink sheet market, the stock can be in bankruptcy, and the stock can even be below $1 a share, 1 penny a share. So a traditional penny stock, in my view, would be a stock between 1 penny and 99 cents, trading in increments of 1/100th of a penny. But again, because of that, they're going to trade very slowly between these ranges of 75 cents to $1. And then as soon as they break $1, it's only 25 increments for the stock to go from $1 to $1.25. So essentially what you have here, just to give you a visual, is between 75 cents right here and $1, and then this is $1.25. So between $1.25, you've got, there's 2, and then 4, and then there's 8, and then 16. So I'm just trying to make approximately 25 cents. We'll ballpark it. So let's just say that's 25 cents. That's from $1 right there. That's from $1 to $1.25. But from 75 cents to $1, for every penny, it has 100 hundredths of a penny. So for 10 pennies, there's actually 1,000 increments. Okay, here we go. We haven't gotten to 1,000 yet. So that's how many increments it has to move through to get from 75 cents to $1. We're not there yet. It's going to be a little while. Now, once it breaks through $1, very quick. And that's what we often see. Very quick moves once stocks break through $1. Okay. So again, traditional penny stock between 1 penny and 99 cents. And so this is how you could look at it without the zeros. And usually in your trading platform, I have the window here. Usually I can go in here and I can click on this. And I can actually change my layout to show how many decimal points I want to see. I can't remember where it is. Oh, it's right here. So, but this one doesn't, I don't even have a penny stock in my mind that I would know to pull up. But it looks like that actually just did it for there. In any case, you can still do it for cheap stocks. LFIN, is that a penny stock? Yeah, there you go. So this one's at 30 cents right now. Anyway, so now you can see how this trades. Now this happens to have a big spread. Just because there's 1,000 increments between every 10 cents doesn't mean that it necessarily has orders lined up there. Similarly, a stock sometimes will have bigger spreads and there won't be 100 orders lined up between every $1. And that can be that's a factor of the float and the amount of traders that are trying to buy and sell. So in any case, all penny stocks will trade down to the 1/100th of a penny. So I guess we'll leave that there for now. So this is what it would look like on your typical trading platform. Now, a sub penny stock, all right, so a sub penny stock is a stock between 1/10 of a penny and 9/10 of a penny. So if you split a penny into 10 little itty bitty pieces, that would be called, each one would be a sub penny stock. So you could have a stock like this that's trading a 1/14 of a penny by a 1/16 of a penny, which, if we're going to be honest, means the stock is probably pretty bad. That's pretty bad. But it's just my opinion. So the charts are usually worthless. You usually can't see anything on them. They're impossible to read. Everything is basically says 0. It just rounds down to 0. And then you have what's called triple zero stocks. Triple zero stocks are priced with 3 zeros. So how does that even happen? 0.0001. That is the very end of the line. That's the bottom of the market. 0.001, that's the bottom of the market, and that's a pink sheet stock. You're never going to see a stock like that on the New York Stock Exchange or NASDAQ Stock Exchange. They are at the very bottom. And as you can imagine, these types of stocks are often used as vehicles for manipulation, because if you have someone that buys millions and millions and millions of shares of a stock at you know, whatever, 1/100th of a penny. Or perhaps they, through some, you know, some deal with the company, I don't know, you know, some of these are Panamanian companies. So through some deal, they don't even have to buy the shares. They're just issued, you know, 10 million shares in exchange for, you know, doing something, who knows. So now they've got 10 million shares. Now they start going on the message boards. They start sending out emails. This stock, 0.001, it's going to go up 1,000%. And you know, if it goes to 0.0002, they've doubled their money. If it goes to 0.0003, they've tripled it. And then so on. If it does get up to 10 or if it gets up to 1 full penny, 1/10 of a penny, that by itself would be a victory. If it gets up to a full penny, that would be huge. Now, of course, that's not common. And what usually happens is, you know, these are what we would traditionally call pump and dump schemes, where some insider or some person acquires a very large position. They don't tell anyone that they've acquired it. They then start putting out false news. So they start making up news to try to encourage other people to buy the stock. And then they sell it as the stock goes up. That's what a pump and dump scheme is. That's the extent of it. So it's very specific to taking a huge position, traditionally of a penny stock, not telling anyone, putting out lots of news as if you have no bias, and then selling as the stock goes up. So we don't trade 000 stocks. In fact, we don't trade any stocks that are penny stocks, because they just, not only do they all kind of carry that risk, because of the decimalization down to the 1/100th of a penny, I would just prefer to focus on stocks over $100. So that's what I trade. So this is the bottom of the line here on this stock, 0.0001 by 0.0002. That's it. And that's a stock chart that it doesn't even make sense. There's nothing there. So you already, I hope, knew this, but this is not the type of stuff we would ever trade. You won't hear me trading penny stocks. So to me, volatility, but with less risk than a traditional penny stock, would be focusing on NYSE and NASDAQ listed stocks. It doesn't mean that day trading is not risky. It doesn't mean trading something like GME doesn't carry potentially a tremendous amount of risk, because obviously it does. But in any case, this is a liquid financial instrument that you can get into, you can get out of, and the risk, while it's capped to the amount of money you've put in the trade, like I suppose anything else, as long as you're not trading short or selling naked calls, it to me is a safer place in the market to focus my strategies. So by focusing on stocks between $1.50 and $10 with floats of under 50 million shares, I can benefit from volatility, while at the same time creating a little bit of risk protection, because I have my threshold cut off at, you know, about $1.50. Occasionally I will trade a $1 stock or something at 99 cents to anticipate the break through $1, and then that quick rip up to like $1.15 or $1.25, possibly into a circuit breaker halt. But that's very rare that I do that. It's just every now and then we get into a little bit of a rhythm where that'll happen like 5 times in a row. And because traders have this very short-term memory, kind of anything doing that, people jump on very quickly. And so anyways, if that's what's happening in the market, I do adapt to the current market, but I usually would not be trading those types of stocks. So here's an example of a stock that went from $1.80 to $3. And so, you know, from $1.80 to $2.80, there were 100 increments. That's 100 cents. But likely it was trading with spreads of, you know, 2 to 5 cents. So it didn't take a whole lot for this to go up from $2 to $2.25, $2.30, $2.50, $2.80. Next thing you know, you're halted going up potentially. Bull flag, next leg up. And these are the type of stocks that most even slightly educated traders are going to be looking at. The least educated traders out there, and this isn't this is not an insult, but it's just sort of a fact. And I know it maybe sounds like an insult, but I'm really not trying to be insulting. But it's usually those with the least education that are going to be trading the crappiest penny stocks on the market, because they don't know better. And I was the same way. And my hope is always that through taking this class, I'm able to help spread that awareness and knowledge to you. So if you ever have a friend or a relative or someone that's like, yeah, there's this stock, it's trading at 1/10 of a penny, and everyone says it's going to be the next one to go up to $10, you can hopefully do them a favor and point them in a different direction, and certainly for yourself as well. So let's see. Did that update? Let's see. SPY. I'll find it. No, it didn't update. I thought I was trying to get rid of those 4 zeros. Wait a second. Maybe I have to log out and log back in. I don't know. All right, so it's fine. here's another example of a stock from $1 to $1.95 or $2. I mean, there's so many examples you'll see as we go on in the class, but these are the type of stocks that we really want to be focusing on. This is what we really want to be trading. So from $2 to $6.80, you can see right here, this was a huge move from 2 to 3 to 4 to 5, pullback, then up to $5.50, pullback, then up to 6, then up to $6.50, then up to $6.80. So, you know, this is obviously absolutely incredible. So reducing risk. Although many traders feel comfortable trading OTC stocks, and I prefer NYSE and NASDAQ listed stocks. For traders who do prefer OTC stocks, I suppose it's important just to understand the different tiers of the OTC market and try to manage your risk accordingly. But I think trading NYSE and NASDAQ stocks is going to be safer and more scalable. You know, today's a day where my profits really scaled to a kind of remarkable level here. And I don't think I would have ever been able to do this trading literal penny stocks. All right. And then number 4, finding your place in the market. So is your place in the market trading, you know, niche kind of, you know, bottom of the barrel penny stocks? Maybe, probably not, but maybe. Is your area in the market focusing on large caps, mid caps and large caps? Maybe. That might be something you decide you prefer. Or is your area focusing on, you know, small and maybe slightly medium caps that are very volatile with news? And, you know, that's my area. So we all have a different area in the market where we focus. Generally, it doesn't make sense to try to do everything at once. You've got to find your spot, your niche, and just really get good at that. Get good at one strategy. So naturally, through trading in the simulator and practicing, you'll start to get a feel for what you think you're kind of good at. And so once you start to get a feel for it, that's when, you know, you're going to be like, okay, I'm kind of getting in the groove here. So being good at one strategy, learning to tread water in the market. If you could be good at just one setup within one strategy, you can be successful ultimately. If you can be good, and that's a lot of ifs, but you know, it's just putting it out there. You only need one strategy. Can you have the discipline to just wait for that one setup to come to you, to not chase everything else that's moving along? And you know, that's something that you may struggle with at first, but ultimately will be a mark of any successful trader, the ability to stay focused on what you know is your go-to setup. So remember, sometimes trading is great, sometimes it's not. And we can't control greater market conditions. We can only ride the momentum and the price action that's right in front of us. There are greater influences that are out of our control: weather, power, internet, technical issues, economic issues, all of these things. Trading losses and commissions are a cost of doing business. If you try to compartmentalize the losses as a, well, this is a cost of doing business, and in every loss is a lesson, I think it's a good way of looking at it. And being self-employed as a trader, and hopefully some of you do have secondary and alternative sources of revenue and stuff like that. But being a self-employed trader does mean learning to get through, getting through the hot streaks, capitalizing on the hot streaks, but then being able to get through kind of the slumps with composure. It's really important. So some steps that you can take today as you're beginning your journey: tracking all of your simulated trades, either in a spreadsheet or trader view. Stop trading with real money until you've proven you can be consistent. If you currently have trading history, import that history into TraderView and see what your benchmark is. Where's your starting point? You have an opportunity to data mine all of that information. And I'll say it a lot during this course: don't be a follower. Don't just blindly follow me or anyone else. Build your watch list. Take the trades you understand. If we're trading the same stock and we're trading the same setup, then it probably means you're focusing on the right stock to trade, and that's okay. But trade because you understand the setup. All right? So with that, we're going to continue on to Chapter 1, Part 2. All right, so we're going to keep going here with Chapter 1, Part 2, and this is a beginner's day trading plan for while you're going through the classes. So I presented a modified version of this at the end of the starter class, and now we're going to kind of fill that in with a little bit more depth. So this beginner's trading plan gives you the opportunity to practice in the simulator while you're going through the classes. This ultimately is the beginning of a multi-month process of studying and trading in the simulator and gaining experience. I do not expect you to be trading with real money until you finish the classes. So I don't want you to get discouraged if you're losing money in the simulator. There's no question that sim trading, although on the surface you might think this should be easy, that it can actually still be fairly difficult, and you can still manage to lose while sim trading. So give yourself the chance to kind of, go through the ups and downs, gain experience, and let's put together a basic trading plan that you can follow, while you're getting started. So, all right, girl, going back out. So I think it's very important that you follow a pretty strict plan. This will evolve as you gain more experience, as you learn my strategies, and as you learn other strategies, and that's fine. But this is sort of a starting point. So we're going to begin with the daily mental checklist. Did I eat well? Did I sleep well? What's the condition of the overall market? Do I have one or two stocks that I like? How's my trading been for the last few days? And then based on the answers to those questions, that helps dictate what your max share size should be today. So I already presented that pretty much at the end of the starter class. Setting daily risk and profit goals based on the mental checklist is important. For me, having such a wild week here, it's kind of hard for me to know what a realistic goal is when I have days where I'm in the six figures. But it is, it's one of those things that I try to come back each day, calm, cool, collected, centered. And if I am feeling like, all right, I've been having a really rough patch, I got to set smaller goals. If I've been feeling like I've been doing really well, I'll probably set bigger goals and bigger max share size, bigger risk parameters. Today, I was actually down $25,000 at one point before finishing up as much as I am. So, I increased my max loss on the day to allow myself to be down 25 grand and continue trading in this market. That made sense. So I asked myself, is this a $500 a day market or a $5,000 a day market? And sometimes it's is this a $5,000 a day market or a $25,000 a day market? And right now it seems like we're in more of the $25,000 a day type of market. So even if I've done, everything right, if the market is slow, I do just have to take it easy. Done everything right from the perspective of risk management and, and also from the perspective of my daily pre-market checklist. And I just, if I feel totally centered, I feel really good, but the market's really slow. It's $500 a day type of market. Well, I just got to work with what I'm given. So the first part of your trading plan breaks down some of the details of your max risk per trade. So let's say $50 of risk. So 500 shares times 10 cents would be $50. 250 shares times 20 cents. 125 shares times 40 cents. Full size, 1,000 shares. Maybe doubling out and adjusting stops to break even, but only after you're already green, right? So trying to set some kind of threshold there that, all right, this is my max risk. And then based on my max risk, this is the share size realistically that I should be focusing on. This is my profit target per trade. This is my profit target per day. This is my weekly goal. Usually I would say daily goal times 3 or something like that. So it's not realistic necessarily for, I don't think any of us to consider that we would be green every single day out of the week. So rather than saying my weekly goal is my daily goal times 5, I would say weekly goal is daily goal times 3. And then also limiting yourself to the number of trades per day can be good, but also when you're getting started, gaining a lot of experience is important too. So during that kind of first period of trading of just gaining experience, it's okay to trade a lot. Now, the second part of the trading plan is adding a little bit more of this depth of what price stocks will I trade? What float will I focus on? What time of day will I trade? When will I stop trading? What type of entries will I focus on? What type of entries will I avoid? What's my primary strategy? Maybe momentum. What's my secondary strategy, right? And sort of going through those details to figure out with a little bit more focus what your game plan and what your approach is going to be. Some of this will become more clear as we go through the classes. Now, part 3, this is where we're going to start to plan about tax liability. Obviously not a factor when trading with simulated money, but when you trade with real money, it will be a factor. Asking, how do I want to separate my profits between long-term account and short-term account? How much of my trading profits need to cover cost of living? How much can just get put away? Should I trade in my personal name, an LLC, an S Corp? How will I account for the expenses related to trading, the monitors, everything else? What will I do if I experience a large loss? And how will I prepare for the inevitable slow periods that come with trading? Again, a lot of the answers to this will become clear as you go further into the classes, but beginning to ask yourself these questions and document it is, it's the beginning of putting together a trading plan. So when it comes to your trading rules, these were mine, and they vary, and your rules may vary based on different market conditions and things like that. But setting a max loss per day is important. I usually would say you don't want to lose more in one day than you can make in one good day. Max number of consecutive losses. So if you have 3 losers in a row, it's like, all right, man, it's time to call it a day. Do not trade large cap stocks. Avoid breakout setups because those breakout setups don't usually work well, and I'll lose money on them. I avoid the third pullback. If I'm not already green on the trade, I won't trade it at all. I avoid buying after the third halt if I'm not already in the stock. And that's the third consecutive halt if you have 3 halts in a row going up. And then the punishment for breaking the rules. You tell me, what's your punishment going to be? You know, you've got to find some rule some punishment for breaking a rule. So whether it's running or it's sit-ups or pull-ups, whatever it is. And initially, you may only have a few rules because you want to do a lot of trading. And that makes sense as a beginner, but at a certain point, you do have to start thinking about, all right, I need to start enforcing some rules and getting things dialed in. Now, part of the daily routine should include maintaining your trading records, and the record keeping isn't for a tax purpose because that'll be done with a 1099 from your broker, but it's for the purpose of tracking your success, your progress, what's working and what's not working. And that is very important. That, for me, as I've said, was part of my learning curve and sort of turning point. So I would always say to trade in a simulator until you have at least 1 month of profitability. Prove to yourself that you can choose the right stocks, the right patterns, and consistently come out ahead. Right now, it's not so much about how much you make. It's about building consistency and confidence. So you're in this class to learn. So let's do it the right way. Let's set a solid foundation. Practice, practice, practice. Now, once you are consistent and profitable with good accuracy, good profit-loss ratios, that's when we go to phase 2 of the trading plan. Phase 1 is trading in a simulator. Phase 2 is taking the wheels off or trading wheels off and putting it out there with real money and seeing how it works. So towards the end of this course, we'll discuss the trading plan for real money, and we'll also discuss pretty extensively the process of transitioning from sim into real money. Now, it's definitely important to set realistic goals. Not only should you not expect to never lose, that would be unrealistic. You should also expect that as a beginner, it will take months at best. At very, very best, it'll take months for a beginner trader to generate any profits. And at worst, you may not find any success at all. So have a contingency plan. If this doesn't work, this is the place where I draw the line in the sand. Or if it's not producing enough revenue, this is the place where I say, I've got to either do something else on the side to make up the ground or whatever the case is. Don't expect to make $100,000 in one day, possibly ever. You know, to be honest, of all my students in the 100K club, I think there may only be one of them or maybe 2 of them that have made over 100 grand in one day. So even among successful traders, it's really quite rare. It's quite unusual. With trading, survive till you thrive. Keep your head above water. And if you can keep your head above water, if you can survive till you thrive, then you know you've got a much better chance of getting through it. It's just one of these things that unfortunately part of surviving is gaining experience, learning lessons the hard way, but keeping your head up, staying in the market, getting knocked down, but getting back up again and just really sticking with it. So, you know, it doesn't happen overnight. There's no question about it, but it's just slow and steady. Keep your head above water. Every day that you come in, you're gaining experience. Every day that you're watching me trade, you're gaining experience. So just just try to absorb all of that knowledge that you're able to sort of pick up off of me and off of other traders, from the live archives to the actual trading sessions to the classes, and just really try to fully immerse yourself in this endeavor to really try to understand the markets. And again, like I said, you know, if you end up finding at a certain point that you're not making as much as you want from trading, my strong hope is that this class will still only help you in your life, when it comes to being better with understanding finances and the financial markets in general. All right, so with that's kind of a quick Chapter 1, Part 2. Now we're going to jump into Chapter